Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'll be reporting flows for the weekend on Wednesday, September 17th, 2014. I don't think anybody would be surprised if they heard that we actually had an outflow of about $11.2 billion from the conventional fund business because of all the rock and roll we've had. In fact, the top of the news that we saw, basically retail sales came in really strong. We saw that the consumer confidence came in very strong, but people were very hesitant on what was going to go on with the Fed. The Fed meeting was this week. Also, they were looking at some news that came out about China and their growth situation over the weekend that was looking poorer than expected. And then last but not least, I think people really wanted to find out what happened, what was going to happen in the secession vote for Scotland from the United Kingdom. And, as things went on, things were improving a little bit. We saw by the end of Wednesday that actually the Dow popped up, had, one of its best weeks, same with the S&P 500, in almost 4 or 5 weeks. But in addition, the Dow actually hit a new high as well. But let's see how this translated into flows to our macro groups. Equity funds took in about $600 million. We saw that taxable bond funds added about $600 million to their coffers. And then if we take a look at muni bond funds, came in about $200 million. So really some good numbers. Where the lion's share of that outflow I was talking about of the 11.2, we actually saw about $12.6 billion in outflows from money market funds. And, I guess you can kind of expect that when, people are starting to put money back to work. Well, let's take a look at what happened to the equity group. Again, I told you that the Dow saw record returns, but when you take a look at Wednesday performance, we saw that the group was down about 0.41% for the week. Not bad. Second consecutive week, though, that we've seen losses out of that group. And when we take a look at the inflows were again about $600 million, and it's this fourth consecutive week we actually see positive inflows. So that's a good sign. If we take a look, though, domestic equity funds actually lost money. For the fourth consecutive week, they saw about $600 million exit their coffers. But on the flip side, when we saw international, took a look at the non-domestic group, the international group took a lot of money in. It's the 40th consecutive week that they've actually taken in net new money, and this time it was the tune of $1.3 billion. Breaking that out, though, if we take a look, a lot of people would have thought it would have been small caps that got 1-2 punch on the chin because they actually had some bad returns, but really people got rid of their large cap funds on the retail side. On the non-domestic side, though, we saw international equity funds taking about $1.2 billion, and emerging markets, even though we saw bad news out of China, taking about $400 million. Well, let's see how kind of these tidbits of news actually came out and translated to ETF flows. Take a look at ETFs for the 6th consecutive week. We've seen inflows this time to the tune of $6.1 billion. Really, the lion's share went to the SPY, the S&P 500, and they saw about $5.7 billion come into their coffers. iShares Core S&P 500, the mid-cap fund, took in about $1.2 billion. And on the flip side, if we look at the bottom, remember I told you that it was kind of a rough time for small caps and technologies. Well, we saw ProShares QQQ take it on the chin, 1-2 punch, $1.1 billion in outflows. And if we take a look at the iShares MSCI emerging market, they lost about $850 million as well. So again, people were kind of being prized there. A little bit of tale of two cities, though. We saw that the investors actually on the retail side still embraced investments into the international market, where we saw just the opposite on the ETF side. We saw people going after SPY and getting rid of emerging markets. So that was quite a story. Well, let's go ahead and take a look at our fixed income funds to see how flows did there. For the 6th consecutive week, we saw positive flows as well, about $600 million into that group. This is the second consecutive week, though, that we've seen negative returns, 0.24% loss for the week. Not a lot to write home about, but certainly some negative numbers. Where the money went into, though, is where people were looking for yield. Flexible portfolio funds took in about $600 million. That was the 37th consecutive week that they've seen net inflows. And corporate investment grade debt funds actually took in money for the 20th consecutive week, taking in about $400 million. On the flip side, though, if we take a look, high yield funds actually got a 1-2 punch. People weren't willing to go that far on the risk spectrum with the opportunity of increasing interest rates coming down the path. So why don't we take a look at what happened on the ETF side to see where flows went on that. Big outflows for this group. $3.1 billion on the ETF side for fixed income is really a big number. And we saw that it was the 3rd consecutive week that they actually have seen outflows. Here's how it broke out. iShares 20-year plus Treasury bond fund saw about $170 million in net new money coming into the coffers, and where we saw some big money leave was iShares 7 to 10 Treasury bond ETF, lost about $2.5 billion. That's quite a story. And again, that $3.1 billion in outflows, while not a record, it's certainly way up there. Normally we're talking about in the hundreds of millions, and this time we were in the billions. Well, let's see what happened on the muni bond fund side. Actually, for the sixth consecutive week, we saw inflows, this time to the tune of about $180 million. And it's the second consecutive week, as well as the taxable brethren, that they saw a negative performance, this time to the tune of just 0.04% as far as their loss goes, so not a lot. National munis, though, actually took in the lion's share, $187 million, which left the remainder $7 million as far as outflows go, come from single states. That's something that we've seen for quite some time, and in fact, it's the 10th consecutive week that we've seen this pattern occur. Well, let's go ahead and take a look at money market funds, and that'll be our last category to go over. For the second week in three, we saw outflows, this time to the tune of $12.6 billion. Taxable money market funds saw about $11.7 billion in net redemptions, and then we saw the tax-exempt money market funds losing about $900 million. And how that broke out is we take a look at institutional funds, they lost about $11.7 billion, and then $11.9 billion, and then we saw inflows, probably to a little bit of frightened retail client, $200 million of net inflows. Well, as we approached this week and got through the week, we found that the Fed actually sent us some good messages. Basically, the Fed came out and said they're going to hold interest rates near zero for a considerable amount of time. They didn't say for the foreseeable future or anything like that. They softened the words off a little bit, but it took a little bit of that fear off the market, and we saw that Scotland, in their vote, decided not to secede from the United Kingdom, and I think that was a relief as well. And so we'll have to see how those impacts actually play through. Market did pretty well over the last several days, and what that plays out, and flows increase as well for next week. Well, you can actually go and do a deeper dive on what just happened this past week by going to lipperusfundflows.com and do a section by section or sector by sector analysis on your own. Or you can wait till next week, on next Wednesday. We'll actually produce it on Friday, where one of our analysts will talk about the current flows. Well, until next time, my name's Tom Orzine, wishing you the best in your wealth planning and creation. Thanks for attending.